Welcome back, guys, to another roundtable. My name is Adam, and with me I have Rusman.
Hello.
And Victor.
Hi, guys.
All right. So at this roundtable, we're going to talk about Amazon and Alphabet's stock split. So this has already been announced, and Amazon is going to split their stock in June and Alphabet in July. So what this essentially means is they're going to do a 20-for-1 stock split. So if you have one share of Amazon and Alphabet, you're going to have 20 shares after that thing happens. All right. So typically, this is good news for investors, correct?
Yep.
And the market usually thinks that, during a stock split, when this happens, stock prices tend to go up for companies that split their stock. And we want to find out if that's true and whether you should act on something like that. All right.
Yep.
So quick details into the stock split before we begin. What's happening with that?
Yep. So basically, to give a brief background of what exactly is a stock split is, you can imagine as you have this Amazon is a pizza, and now instead of you owning the whole pizza, you cut it to different slices, 20 slices, right? And that's basically, but you still own the pizza.
You still own the whole pizza,
yeah,
right?
The value is still the same, just that you cut it to 20 slices, and if you want to sell one slice away, is easier instead of selling the whole slice away.
Yeah, I think that's really easy because everyone understands pizza.
Yeah,
Because if, for investors who want to buy shares of Amazon or Alphabet, I think one share is equal to 2,000 plus for Alphabet. So that typically is a lot more costlier versus if let's say your shares is like one share is like $200 or $100, then there will be more people are able to buy into the share. So that will actually improve the liquidity. And when the liquidity is improved, typically the spread bid and ask price typically is lower, and that will reduce the trading cost. Okay, and that generally will improve the liquidity of the stock itself. Okay, and that will translate to the valuation.
Yep.
That in theory. Okay,
that's
so
right.
yeah.
So last time, if you have $1,000, you can't buy Alphabet or Amazon. But now, if you have $1,000, you can buy any one of them.
But nowadays, we do have fractional shares trading as well.
Definitely.
But again, it still helps that when you look at the share price of Google is 2005, 2006, and you go like, wow, that's really expensive. How am I going to swallow the whole thing?
Yes, yeah.
I mean, there's still fractional trading, I know, but and you need to find a broker that actually provides that for you. If you don't, then you're stuck with that whole thing. So a stock split is popular among investors because it just makes things a lot easier to buy and sell.
A lot more affordable. And of course, those people who actually invest in option, they generally will, if you look at the one lot of option, which is typically will have 100 shares, 100 times that share price, that is the amount that you need to exercise for your option if let's say it's a put option.
So for Alphabet, it was still at 2005, 100 shares of that would be quarter million.
Quarter million.
Yeah, quarter million.
And it's also easy for you to rebalance your portfolio, right? So if you look at Amazon right now, it's about 3,100 plus. So after the stock split, it's about maybe 150 something, right?
Yep.
So let's say I just want $1,000, but I got one share of Amazon. I don't want to sell everything, right? I still want to own Amazon. But because of the stock split, you're able to sell Amazon to get $1,000, but you still own Amazon.
All right. So I think we can tell that stock splits are popular, and most people think that, because of a stock split, prices will actually go up.
Yeah.
And we want to find out if that's true.
It doesn't change the percentage of the shareholding that you have in the company. Right.
Yeah.
So if you own 0.1% of the company before the split, post-split, you're also going to be 0.1%.
Yeah.
Right? It's a lot. All these are share split, mostly cosmetic, but it's just that people liked it, and that's why the market tends to go up. I think based on the research done, they did this research from 2012 to 2018, and those companies have completed a split of 1 to 2 minimum, and they have actually outperformed the index as compared to S&P 500 on the announcement date. Typically, after they announce the share price will outperform or goes up. Right? This is what happened with Amazon and Alphabet by 2.5%. But close to a year, you are looking at about around 5% outperformance against the index. Yeah.
Okay, so the data actually shows that companies that split their stock do better than the benchmark.
Yes. Yeah.
All right. So it's actually true. So what people think is actually true.
Yeah.
Okay.
But actually, I got another data over here. It really depends on when it happens. So, right. There's an article by Wall Street Journal. They collect the data all the way back since 1980, right? Then they see that as overall, the stock splits do beat the benchmark. But there's certain stocks, right, where if you buy at a certain time period, right, you do not beat the benchmark. So, but the share price still go up, but just that you don't beat the benchmark. So, for instance, you buy during the boom year, right? there's high chance that you don't beat the benchmark. And if you buy during the normal years, they shows that you beat the benchmark, right? So, but as a overall, if you add them all together, the stocks, they still beat the benchmark, right?
All right. So the data actually shows that yes, stock prices tend to go up.
Yeah.
So I think if people know that, and our performance is about what, 3 to 5%?
5%.
About 5%?
A year later. Yeah,
Okay, a
after
year
the
later.
split.
So you're looking at a 5% gain in a year compared to the benchmark. It seems pretty, you know,
not bad,
Not
actually.
bad.
Yep.
You know,
Yeah.
people would think of like maybe I should do a play on this. So what would you say to that? Like people, if if someone came to you and asked, hey man, I heard that Amazon and Alphabet are going to do a stock split. Should I buy some stock right now? What would you say to that?
Depends, right? So if, let's say the market is going to tumble in the next 5 years, 5% outperformance is also going to be underperformance at the end of the day. So I think the decision at the end of the day, if you're intending to buy Amazon, it should not be based on share split, thesis, right? So,
Okay.
but if you already have done your homework and you think Amazon or Alphabet is a company that you would like to own in the long run, and it just happened that that they actually made an announcement recently, and then the question is, should you buy or before and after, right?
Yep.
So if the price is attractive now, typically you just buy it right
Okay.
now, right? Because it's already attractive and you don't know what's going to happen post split, or
Yep.
the market may have changed, it may goes up, and then you're going to miss the boat there,
Mhm.
right? So, but based on stats, it is better to buy before split.
Okay, okay.
The research that we have just talked about, right?
Yeah, but if you don't have enough money, then you just buy after split.
Because you can only buy
Yeah.
the
Yeah.
smaller shares.
That's
If
a practical tip.
if your broker doesn't provide you fractional trading. All right, but so I think it still boils down to the fundamentals
Yep.
and the valuation.
fundamentals.
You don't try
Yeah.
to trade a stock thinking it's going to beat. But like you said, yeah, it could beat the index, but the whole index goes down, you're still going to lose money.
Yep.
So you
Yes.
still want to buy something that's of value, is going to hold its value. You're going to have a
Yeah.
long-term perspective on that.
Yeah.
5-10 years from now, it's going to be worth more.
Yes.
So in the case of Alphabet and Amazon, they are great companies to own,
Yep.
Yeah.
and it should be safer in a sense.
Yeah, so I think at the stage of this recording, their valuations are on the fair valuation side, right? So I mean, we bought Alphabet a few years back when it was trading at a fair valuation, and yet the company continued to rise. You don't need to own great companies at undervaluation, right?
Mhm.
Typically, if you look at them, if you really believe that they're going to stay in the next 5 years or 10 years, you buy them at fair value. It should continue to run, right? So until there's a next disruption, they're going to come in and take over. Maybe for Google, be a search. For Amazon, it's going to be e-commerce or cloud.
Okay, so at this point, the fundamentals are still very robust.
Very
Yes.
robust, yeah.
And their fair value at this point.
Correct.
For both
Yep.
of them.
Both of them, yes.
Yeah.
Yeah.
At the time of this
At the
recording.
time of
yeah.
this
Yeah.
recording, and that's based on usually we use price to cash flow for these two companies.
Yep.
Yes.
Yeah, typically. So yeah, I think this. I think Warren Buffett has said this before. It's better buy a great company at a fair price
Yep.
than a
Then-
fair company at a great price.
Yes. Yeah.
Right. So I think these two companies are, some of the biggest in the world. They are part of our everyday lives, especially for Google for me, actually.
Definitely, yeah.
Yeah.
You can't. I don't know what to search other than using
Same thing
Google.
for Amazon, right? If
Yeah.
without Amazon, you won't be able to watch Netflix. Right? We should talk about
AWS is now part
Yeah.
of the. It's not. People think of Amazon still like e-commerce. And
e-commerce.
Yep.
Yeah.
But the AWS runs a lot of the architecture on a lot of the websites that we
Yes.
use actually.
yeah.
Yeah, so Netflix is one of them. So if you're wondering about whether you should buy a stock because of its stock split, I think our suggestion is that don't do it based on that.
Yeah.
Yep.
Go back to the fundamentals. Does it make sense? Is the valuation okay? And then if it's all of that passes, then the stock split is like a bonus.
It's a bonus.
It's a bonus. It's like a booster to your returns if it turns out that way. And on average, it does.
Yeah, based on Tesla, they've done it a couple of years back. Apple also had done it a few times of share split. Share price keep on going up.
Yeah, but I still think it's because of their fundamentals they're doing. Well.
Yes.
Yeah, and then the split just kind of like adds that booster.
Yeah.
Yeah, so don't make the play just because of a stock split. Make sure you want to own a company for real for the long term,
Yeah.
5-10 years, and it's a great company to own. So in this case, Alphabet, Amazon, they passed the test.
Yes.
All right. So I think it's a pretty good recap of this roundtable. If you're thinking about owning Amazon, Alphabet for the longest time, haven't taken action. This is not a recommendation to do anything. Please make your own due diligence whether it makes sense for you. But the stock split is pretty much a good thing, good news for investors
for the
everywhere.
shareholders, yeah.
All right. So I hope this roundtable really helped you out with that. And once again, my name is Adam. That is
Thank
Rosemary.
you.
This is Victor. I
Thank
hope you
you.
enjoyed this roundtable. Of course, if you like this content, please hit the like button. Tell us we're doing a good job. And of course, any questions about the stock splits or anything like that, put them in the comment section and subscribe to our channel. Many more roundtables coming up again. See you around.